Good morning. It's Friday, December 5th, 9:23 a.m. Got a lot on my mind that I want to talk about today. I want to review a comment from Doctitus. I want to talk about market structure. We've got a bunch of stocks I want to run through. New market structure is a follow-up to yesterday. And so we're going to jump in. Housekeeping items. I mentioned this in a post on live chat at the Contrarian this morning at Seeking Alpha. But Warner Brothers Discovery, Netflix has won the bidding war for them. It's hard to believe, but Warner Brothers Discovery was a FAM-DCA purchase a number of times along with Paramount. The stock was after the April decline in the market. The stock was down in the sevens. The buyout price is $27.75, including $23.25 in cash. So heck of a return, over the last 6 months or so. Or um, and it was funny because Paramount was bidding, Ellison there that took over, and then Skydance, they had merged, they were bidding. Comcast was bidding too, so that was kind of interesting today. And then Victoria's Secret, which TurboCat Aaron had recommended or was looking at, and um, I never purchased it, but I followed it because I've been on this VF Corp VFC, and they're both retail oriented. But Victoria's Secret has done better, and it's rebounded pretty well from its lows too. Their earnings were up about, or revenue was up 9% year over year. The earnings estimate, was a loss of 59 cents for the third quarter. They actually only lost 27. Then they guided better, so they raised their guidance for this year, and for the fourth quarter, which is another notch of or a item that we can put on when we're looking at the retail market. Williams Sonoma has been stronger. Ross Stores has been stronger. Gap has been stronger. So and Turbo did a good job of in a post in live chat saying that, Target's been weak, but there's other parts of the retail market that have done better. And as you're getting data point after data point, including from Victoria's Secret, it does look better. It makes me encouraged for VFC, which they have North Face and Timberland. Vans, which is a turnaround, but they've also come up nicely. That's been a FAM-DCA purchase. Another housekeeping item, and this would be a teaser and tag too. Henry Hub prices are above 5. I saw Tom T. Worth say that he sees a path to 6. I do too. Weather's, we're in the weather roulette wild card. Gabriel Gringo's get a lot of good stuff, on our channel, the Antero Valuation channel. Something I wanted to point out was that what's happening with Henry Hub rising and then pressure on Asian and European gas prices is that spread is narrowing. And my informed predictive guess is that if that continues, so if Henry Hub keeps rising here, that's going to force the LNG complex that is not hedged to hedge in the years out here. So I think the future strip is going to rise, and it's already looks pretty good in the next 18 months or so, but I think it's undervalued, and a spike will actually drive the longer term future strip higher, not only through the normal backwardation. And remember, we've got 2 months or so of backwardation priced into the market right now. In 21, 22, we had 18 months, so we could just be getting started again, depending on weather. More to come on that, but my takeaway there, the teaser tag, and the housekeeping item too, is that I think the housekeeping item is it's just above $5 in the Henry Hub price. But if it keeps going or even stays here, I think it's going to force the futures curve higher as the LNG complex hedges more farther out on the curve. So with that, I want to jump into, I'm going to read a comment from Doctitus that he posted, and I thought it was excellent. And he said, I got to tear the sheet off here, but he said this is a comment he posted the other day. He said, from my limited experience consisting of the period from late 2020 to mid 2022, there were perhaps 10 days during that period when my own portfolio had eye-popping gains, say 5%, for the whole portfolio in a single day. So yesterday, this was Wednesday, December 3rd, that he's referencing. I had the first similar day since 2022 with his portfolio up 5.7%. Now, Doctitus is very concentrated in a couple stocks, but this is, some of us are that way, in our group. But this is, again, his representative sample. And I love, his comments because they're, he's looking for patterns and historical relevance, and they're just excellent in general. And that's why I'm reading it. And he said, before listening to your 10th podcast, this is my 11th one today, my interpretation was yesterday for me signaled rotation into small value. And your 10th piece strengthened my interpretation as you made the case for the setup in the market where the Russell 2000 is at cheap levels. And I was more specifically talking about the Russell 2000 value, the IWN ticker. And he says, similar to the COVID lows, after 3 years in the doldrums, the light streaming down the tunnel seems to be sunshine, not an oncoming train. Touch wood, knock on wood. I feel the same way. And that's a statement from Doctitus. It leads me into, I wanted to talk about market structure again. Hold on, I'm going to take a drink of my tea. Yesterday, my post was, and I'm going to include a chart, but it was the QQQ, the Invesco QQQ trust to the IWN ratio. That was most of my post. And what I referenced was, actually, we made the peak in 2000, and then the next peak was actually 2020, and then we experienced this because 2020, a lot of our stocks as active stock pickers really started doing well, and into 21, 22. So it made the peak in this ratio, the QQQ to IWM, actually was in 2020, and then it came down into 2021, and then 2022, and I thought, hey, from a chart perspective, this ratio made a lower relative high to 2000. This is the start of the rotation that we've been looking for. And in fact, it was kind of a false signal, right? Because you've had the Qs have come back in 23, 24, 25, because the S&P, was down 22%. I mean, the NVIDIA in 22 at one point at its lows, NVIDIA had lost 66% from its 21 high into 2022 low. So that gives you an indication how much some of the NASDAQ leaders were down. It wasn't as big back then. I think it had peaked at 875 billion or 900 billion in market cap. But you definitely got a decline, and it looked like that rotation was starting. And it made me think of, I saw Max Kellerman was on the Bill Simmons, the BS Report podcast, and Max Kellerman was on First Take for ESPN. He's been off the air for a while, so he had a lot of things he wanted to talk about. But one of the things he said, it was one of his famous arguments was that he felt that he, fell flat on his face with, or it was a mistake, was that he said when Tom Brady was, 40, 41, he said he's going to fall off a cliff. And his rationale, Max Kellerman's rationale, was that every other data point for a quarterback, going back through history, was that they couldn't play, past, 40, 41 years of age. Makes me feel old. At 48, I still feel fairly athletic, although I'm reminded at times, that that has left the building somewhat, with my kids. And going back, looks like I've frozen on here on the screen. Oh, there we go. We're back to it's running. Kellerman said, hey, I wasn't wrong, and he said that essentially I was right looking at all the data. Brady was the exception that we hadn't seen before. And part of that was longevity and how athletes take care of themselves. We see that with LeBron James today. But no quarterback had ever performed like he did. He was the outlier. I feel like that same argument kind of applies to the equity market in 2022 when we started going down. I know the structure of the market didn't change, right? Because it was the market sell-off was spurred by the bond market, and that spurred the sell-off on equities. But the structure with the passive flows hadn't changed to that point yet. So, and then we've got the rebound. But if you look through market history, the odds that we would get a rebound once the reversion started were very low. We really hadn't seen that. But now we're at the point, again, where the QQQ to IWM ratio not only exceeded the 2020 peak, but it's back basically to the 2000 peak. And I do think it's rolling over again. We've seen outperformance by the broader equity market the last couple months. You're seeing it in a lot of our targeted equities. You're seeing it in individual cases like Warner Brothers Discovery, getting bought. That's a nice gain. Things like Deutsche Bank or TCK, or you can go on down the list, right? So it does seem like small caps, mid cap value, small cap value, the Russell 2000 value is getting a tailwind here. Offshore drillers would fall into that boat, by the way. And hopefully that ratio is rolling over. So that leads me to, I kind of teased yesterday, Neighbors. I think Neighbors, which I've had a long history with, haven't been invested for a long time, but that was one that, a long time ago, that was Marty Whitman's cornerstone kind of turnaround stock that led to his success at Third Avenue. It was a single leveraged investment. So I've always kept an eye on it. It's a drilling company. They're off quite a bit from their 2021, peak 2022 peak levels. I think that free cash flow for Neighbors could be north of 30 or 35% on a normalized basis. Right now, it's only like 7%, estimated for 2026 free cash flow. They're going to use that to pay down debt. That's part of that transfer from enterprise value from debt to equity. I was looking at a couple others. Enphase, which is a solar company that's really gotten hammered. It's kind of got, a similar 6-7% free cash flow yield. There's some that fall in that group, that Cogent Communications, which Anderson brought up, that same thing. But those are turnarounds. And, it also, I was looking more into, Sanjay and I were talking about AESI, which is a sand company, the last couple days. Some guys in our group have looked at ACDC, which, I've got some family that has ties into some of those type businesses in Texas. So I've been digging into those. ACDCs, they do proppants, but they're a pumping company too. And I really dug into XIFR, which we've owned in the Stuck on Yield portfolio. But that's the spinoff company from NextEra Energy. They changed their ticker. They still have about 10 gigawatts of electricity generation capacity. Their free cash flow yield to market cap is really good. Their transition to where they have to fund themselves, so they're still issuing some new debt. They're not paying out the distribution like they used to. But it made me think with Neighbors, ACDC, AESI, XFR, Enphase, those all have potential to be significant free cash flow yielding investments, maybe not in 2026, but 2027, 2028. And so it's like Wayne Gretzky, you got to skate to where the puck is going. So more on that, it's funny because things like Transocean have run so much that I did a lot of free cash flow work on them the last week or two, and I want to put that into an article like I did with that May article on the tangible book value. I'm going to have to update some of those numbers. I want to do the FAM-DCA buys. I'm trying to think what I want to drop out and what I want to put in because there's a lot of attractive, companies to buy right now. I still think we're in that early innings of this infrastructure upturn, build out, industrial build out. GDP still tracking strong. I think next year you're going to have really, a boom in the construction market. Things like Caterpillar are kind of leading that. And we'll talk more about that, but that's the agenda. This is my 11th episode. I wanted to try to do it before the market opened. And it's, again, Friday, December 5th. Hopefully you guys are having a nice start to the day, a nice start to December. Thankful, grateful, blessed for all in our group. Enjoy the daily discussion on stocks. And there should be a bunch of opportunity here on an absolute and relative basis. So take that to heart on the good days and the bad days, So have a great Friday. I'm going to hit the stop record and we'll move on to episode 12, hopefully tomorrow if I can keep my new streak going. So take care, guys. Bye.